Good evening, everybody. Understand everybody's having some strange weather tonight. We had 49 degrees here at 5 o'clock and a hailstorm. And they tell me Houston right now has had severe weather. It's knocked out a lot of power. So, but tonight we got the great pleasure again of having Dr. Barry Burns with us. Always like to have him here because he has some very interesting trading strategies. So, not to take up any of his time, Dr. Barry, good to have you back. We're interested in seeing what you got for us tonight.
All right. Thank you so much, Steve. Really appreciate that. Here in Los Angeles, it's 48 degrees and raining. So we don't have sleet or hail, but we do have moisture in the air. It's been a drizzly day all day. My mother-in-law said it's a good day to take a nap, but I haven't been able to take advantage of that, so I don't know. But I guess it is. Anyway, thank you so much for having me. I always love coming on here and, first of all, just enjoy connecting with you before the presentation, as we always do, and talking with you, and just have so much respect for you and everything that you do for Candlestick Trading Forum. You're great people there. Becky's always just amazing, so organized, very professional. Rick, thank you for everything that you do. And I see we have a nice turnout here tonight. So welcome everybody. Oh, DB says you read a book of mine. Well, that's great. I hope you liked it. All right, so today I'm going to do a tutorial on three volume patterns that I'm using in today's markets that are working really, really well for me. And it's really a gift. In fact, I'm just going to tell you up front, they've got nothing to sell today. So I know a lot of times you get on webinars and you think, oh, it's all one big sales pitch. I actually got nothing to sell you today. So put your wallets away, put your purses in the lockbox. I've got some free stuff for you that I'll offer you at the end, and the whole presentation will be a free tutorial. But yeah, I kind of dropped the ball. I've got nothing for sale. So I know you guys are really upset, probably really mad at me right now that, wait, Barry, we just came here with money in hand, $100 bills, just hanging out of our pockets, waiting to buy your stuff. And how dare you not sell us anything? So I owe you all an apology for that. But yeah, I'm just here to share good things with good people. So let's get on to it. So first of all, one thing that I have to share with you is my podcast. So obviously, that's not something I'm going to do right now, but I believe there will be a recording of this presentation for later that Candlestick Forum will send out. But I've got a lot of other audio recordings and programs that I put out there for free to the trading community. So just if you like podcasts, go on to iTunes, Google Podcasts, Stitcher, Spotify, whatever your favorite resource is, and do a search for Top Dog Trading and enjoy. We've got a lot of great episodes on there. Our most popular one is one where I interviewed a trading psychologist. He actually specializes in trading psychology. So go check that out, and many others too. We're going to be putting some brand new ones on there within the next 24 hours. Oh, people must like it. I haven't really looked for a while, so this screen's a little old. But last time I looked, we were at number 10 in the investing category on iTunes. So I believe that's ranked by people voting and stars and comments and all that kind of stuff. So kind of proud of that. Um, Important disclaimer, always have to make our lawyers happy, because if your lawyers aren't happy, then ain't nobody going to be happy. But all kidding aside, this really is important. And I think, unfortunately, people overlook this. They have kind of a legal blindness to it because they think, oh, that's just legalese. Well, it's not just legalese. The regulators have done a great service for us by going out and researching, why do most people lose money trading? Because that is the truth. Most people do lose money trading. So they have done the research for us. And so while this is legal, obviously, it's also educational. And I encourage people, hey, read this. This is there for your benefit. And if you think of it, it's to protect you from losing money. So that's a pretty good thing. That's, Warren Buffett's rule number one is do not lose any money. And his rule number two is refer to rule number one. So these legal disclaimers, that's what they're there to do for you. So take advantage of it. They did all that work for you for free. All right, so now our main topic today is volume. And specifically, I'm going to give you 3 volume patterns that I'm using that are maybe a little unusual. They're not your typical stuff. We'll start out with basics. And so for the beginner people, we'll have some very, very basic meta patterns of volume. And then we'll go on to intermediate level and teach you some things that I use, 3 very specific patterns that I use that are not quite as well known. And then step 3 is for you advanced folks. And for the advanced people, yep, we got some good stuff for you here too that I rarely ever see taught. In fact, one of the techniques, the very last one I show you, I've never seen anybody teach. So I came up with it myself, of course. As soon as I say that, then there's always somebody who says, oh, yeah, Billy Bob's House of Trading uses that. I'm like, oh, great. Nothing new under the sun. So you never know. But anyway, I've never heard of it before. So trading at its core, the core of what makes prices go up and down is essentially supply and demand. So very much like the regular economy, right? So, and nothing measures supply and demand as well as volume does. So in general, here's the 101 basic stuff. Increasing volume as the market moves up indicates rising demand and lower supply. And increasing volume as the market moves down in price indicates rising supply with lower demand. Now, to put some visuals to that, here's a little chart for you, a very simple chart. So we see that price is going up. Oh, by the way, let me ask you guys a question. Can you see my cursor as I put it over to the slide? I'm not sure. I haven't used Webinato very much. I've used it a few times, but I'm not sure if you can see my pointer or not. If somebody could type into the chat. You can't. Okay. All right. So good to know. So I won't waste my time with that. All right. So anyway, that's okay because the arrows are there. And you can see that the blue arrows going up on price correspond with the blue arrows indicating volume increasing at the same time. So the price moving up, that indicates trend, the direction of price. And trend is great. I wrote a book on trend called Trend Trading for Dummies, published by Wiley & Sons. So I'm pretty good with trend stuff. But there's 2 types of trends, and that's not just uptrend, downtrend. There's a professional distinction beyond that. And the professional distinction of trends are these: strong trends and weak trends. In other words, price can go up on weakness or it can go up on strength. And so for today's reference, for today's purposes, we're going to equate strength with volume. So in this case, we have price moving up with strength with volume, which would indicate that it's a strong trend, and therefore, if you wanted to buy a trend retrace or something like that, that it has a higher probability of following through and continuing after you get into the trend, especially if you get early into a new trend. And then here's the opposite example. So now the market's going down, where you see the blue arrow, and we got an increase in volume. So this one's maybe a little less intuitive just because the arrows are in opposite directions, but it's essentially the same thing. The trend is down on price, and volume is increasing, and therefore, in this case, the downtrend is a strong downtrend. And if you wanted to buy a breakout or a retrace to the downside, it would have a little higher probability because we have strength in that trend. And therefore, we would expect it to have a higher probability of following through. All right, now, so that's basic 101 volume stuff. Right, now that we've got that under our belt. Now let's look at the 3 volume patterns. Oh, Jeff says, wow, I did not know this, and this is huge. It is huge. Absolutely good. Well, I'm glad, Jeff, you already learned something new. A lot of you learned something new already. Cool. So that's my goal today, by the way, is to give you real value. I want you walking away here saying, you know what? I learned something really new. This was valuable, and it was worth a lot more money than I paid for it, which it better be since it's free. Okay, so now that we have that basic understanding in place, Here we have volume pattern number one. And volume pattern number one is really powerful because it's kind of a leading indication. Now, notice I used the word leading indication, not leading indicator. Those are different things. There's price is not an indicator. The price histogram here. Now, there are volume indicators, but just having the histogram of the actual volume of the market is not an indicator because it doesn't point to anything else. It's like price. It's just what it is. This is how many shares, how many contracts, how many lots went through the market in that given period of time, in this case, a daily period of time. All right, so the price is going up on the first arrow going up there. And then if you notice right below that, even though price is going up, volume is moving down. So that indicates that price is moving up, trend is up on decreasing demand. Now we're back to supply demand. Nothing measures supply demand as well as volume. So that indicates that this is not a strong trend. This is a weak trend. And that indicates to me that, oh, as this continues to go up and up and up, it's going up on less demand, and therefore it may not follow through. And so if I was going to look for a trend continuation on a retrace or breakout of the previous swing high or something like that, I would be less excited to take that trade. I'd be less inclined to think that this trend is going to follow through to the upside because there's not a lot of strength behind it. So think about strength. We've got different types of volume. You've got retail volume, amateur volume, and I don't mean amateur in a derogatory way. I just mean people are not professionals yet. We all start there. And then you've got your big volume, your institutional volume, your smart money. Okay, and so they got two things going for them. Number one, they just got a whole lot of shares they got to get through the market, a lot of contracts, a lot of lots, depending on what you're trading, and because they're probably managing other people's money. And then they also are the smart money. So they got two things going. They're smart. They're professional traders. They've learned from the mentors, the people who've gone before them at their same fund. And so they didn't learn from, a little 99-cent ebook. No, they learned from a professional trader in the trading room or whatever, however they have it set up, through a mentorship program probably. And so they've learned from the best, and then they had to prove themselves with a track record in order to stay on. And then they got so much money they're bringing in. They usually bring it in through accumulation, meaning bring in some, let the market subside, bring in a little more, because they don't want to just bring all their millions of shares in all at one time, within 1 minute, because that would push the price up too high too fast, and then they can't keep buying low. They want to buy as low as possible and accumulate at an average of a lower price. So that's, again, this is just one indication. This alone is not enough to trade with. Let me be very clear about that. There's other things that we would use, but today we've only got, another half hour here, and I can only cover so much. So I want to be clear. I'm not giving you a complete trading methodology here today. We're focused on one thing that you could add to a complete trading methodology to maybe round it out or give it a higher probability. All right, I want to be very, very clear about that. Do not go out and just start trading these patterns in isolation because it takes more than just this. But this is one piece of evidence when you're looking at a chart trying to decide whether or not you should trade it. Okay, think of it that way. It's kind of a good legal reference. In trading, I put together 5 pieces of uncorrelated pieces of evidence. And that's how I decide to take a trade or not. So volume is one of them. Okay. Now notice as then price comes back down where the blue arrow is, it comes down and there's 2 very significant things there. So first of all, the red line is my 50 EMA. The black line is my 15 EMA. Just to, because I didn't mark them there, just so you know. So when price is going to go up and continue up, I like to see it retrace to about the 15 EMA and then resume its trend. But it didn't. It broke below the black line, below the 15 EMA, went down to the red line, the 50 EMA, and that's if I want to take a continuation long trend trade, for it to break down that low, well, that's no so bueno. Don't like that. Because what I'm really looking for, again, looking at what's going on behind the scenes, not just the charts, but what causes the chart pattern, is I want to see professional money coming in to the upside. And then when we get our little retrace, I just want that to be maybe some profit taking, partial profit taking, and maybe some retail shorting. And that would be low volume, and that would be the unsmart money. And then I want to see the smart money come back in and continue to accumulate. So that's not happening here. What's happening here is it goes down sharply, it goes down dramatically. That indicates to me there's probably some strong short selling there. And indeed, underneath that, volume picks up. So now we've got weakness to the upside. See, now if you're just reading pure price action, you say, well, price is going up. And of course, that is true. But we can't make money on what has already happened, right? My broker, at least, my broker requires I make money into the unknown future where bars have not yet printed. He's very rude that way. It kind of annoys me. I tried to say, just let me make money on historical charts, would you? And he says, no, no way. You've got to make money on the unknown future where bars are not printed yet. It's really rude. By the way, if any of you know of any brokers who do let you make money on historical charts, pass over a referral link. I don't even care if it's an affiliate link. I'll sign up because I am perfect. I have a perfect 100% record with historical charts. So, okay. So you get the idea. So weakness up, strength down. Now um, we want to be trading in the direction of the strength of the money flow. It's kind of like I call it the current of currency. It's like you're in a whitewater river experience and you want to go with the flow. You don't want to fight the rapids, right? You want to go with the flow of the money. That's easy. It'd be hard to go against the flow. So the same thing in the markets. Go with the flow of the money, in this case, as indicated by volume, and don't fight it. And I see so many amateur traders, that's what they're doing all day long. They're just fighting the dominant energy of the money flow. And if you look at the charts, that's what they're doing all day long. So here's another pattern. That's pattern number one. Okay, so that's one way to stay out of and avoid a trend continuation trade that would not follow through. All right, and get a little early advance notice on it because it's moving up on declining volume. Here's number two. Counterintuitive low volume pattern that provides reliable entries. So what we're doing here is we get a long move down. So there's there's four steps in this. Step one has to be an extended trend. So this is an extended trend down. Remember, the trend is your friend until the end. So at the end, it's what? The trend is our enemy. The trend is your friend until the end. So the learning moment of that slogan is the trend is only our friend early in a new trend. The longer it continues, in general, the less probable it is to continue. Now, again, that's just one piece of evidence. So we've got an extended trend to the downside. Then we get a volume spike down there. Okay? Now, we get that volume spike. And I kind of created this myself. I don't know. Again, probably someone else has come up with it. But I was working with a mentor at the time. This is many, many years ago, over 10 years ago. And he used to trade these volume spike reversals, called them exhaustion trades. And it's pretty common. I've seen that on the internet for free. And then he was doing pretty good with them. And then he went through a dry spell of about 3 months where he had a drawdown of 3 months trying to trade these reversals off of these big volume spikes at the supposed end of a trend, right? And then the trend didn't end and he would lose money. But I noticed something as I was working with him actually I worked with him for 2 years. And so because I was watching all these losing trades, I would just keep watching and see what would happen afterwards. And I started to notice a fairly consistent pattern, and it's right there. Price would go back down, just barely break that low with the volume spike. That's where he would get stopped out. And then that next low would be accompanied by a low volume period of time. Then they would go back up, and then they would do a trend reversal. And he kept getting stopped out at the volume spike. So I thought, wait a minute, I'm seeing a pattern here. Maybe if we don't trade the volume spike, we wait for the next low on lower volume. What's happening here? Three parties are being hurt. So one party that's being hurt, one group of market participants are the people who were like him, buying the volume spikes for turn reversals. Second one are the people who are buying the breakouts to the downside. Third group that's getting hurt is the people who traded a trend, a continuation pattern on that high, back to the black line, the 15 EMA there. And so three groups of people are getting hurt. I don't remember who it is. Golly, I wish I could, but there was a book written quite a few years ago where the guy based the whole premise of the book, and I wish I could give credit to whoever it was the best places to trade are where the most traders are getting hurt. And that was the premise. And then he had a whole bunch of setups, which were basically broken setups. And I didn't even hear about that until later. But, there's a lot of logic to that. There's some sense to that. And that's kind of what's happening here. So now you notice by the time that we get the big volume spike, the big green volume spike on the right, you could say, well, now you got a couple groups of people there. Maybe they're trading an inverse head and shoulders. Maybe they're trading a higher high, higher low. But I like to trade that very low where it just barely breaks. It's kind of like a running stop type of a pattern. You don't want it to go down too far. You just want it enough where people would get stopped out there, and then look for it. By the way, this is important too. Look for a good candlestick reversal pattern there. That's very important. We want to see a good candlestick reversal pattern. And I'm only risking the range of 1 bar. And then if we get a trend reversal, well, then we've got a huge reward because we're getting in even before the next higher high, higher low. Professional level trade. I wouldn't recommend this necessarily for beginners, but the risk reward on it is absolutely fantastic. So yeah, bull engulfment would be great. Exactly. Okay, I'm going to skip through some of these because I got some other cool, so it's really just more examples of the same thing. Here's the pattern number 3. Pattern 3 is a mismatch between price and volume. So what is the mismatch? Well, you'll see the arrows there. So where the blue arrows are, you look at the volume bar. We got a big, big volume spike again, big red volume bar. And then right above it, look at the price bar. Very, very narrow range. That's what I mean by a mismatch. Wide range volume bar, narrow range candlestick bar. Now that doesn't seem to make sense. I mean, if you look over at the left of the chart, we got a big volume spike that goes all the way to the top of the subgraph, and then we got another big one next to that, and we got some big, big red, candlestick bars there. Now that seems to be more reasonable, right? You would think that if a lot of volume's coming in, price is going to really move dramatically in its range from high to low or from open to close. So, but then when you go to the one on the right-hand side where my blue arrows are, you got the wide range volume bar, but you got a narrow range little candlestick. Yeah, just a little doji, maybe, let's see, is there any red in there? Maybe it's hard to see, but maybe a little bit of red. So maybe it's a little spinning top or something. But anyway, the biggest point is from high to low, very, very narrow range. So what the heck's going on? Well, the way I look at that is that it's loading its guns. Orders are coming in. Price is not going anywhere, so pressure is building up. And eventually, this thing's going to pop, one way or the other. So we look for this as a contraction. In fact, even if you look at the bars before that, we're all just kind of going sideways. They eventually hit the black moving average there, the 15 EMA. And so we're looking for expansion out of contraction. It's a similar dynamic as with Bollinger Band squeezes or triangles or wedges, where you're getting a contracting price action, and then we're looking for expansion to pop out of that. So this is the same kind of dynamic. It's a different setup, though. So it's called a squat bar. I did not make this up, by the way. I'm not sure who did. But anyway, that's it. Now, how do we trade it? Which direction do we trade it in? That's always the big question. And pretty much I trade it whichever way it breaks out. But what I also do is I look at my next higher time frame. I use multiple time frames on all my trades, and I look for the direction of momentum on the longer time frame. Okay. Oh, the red line, Kartik, thank you. The red line is a 50-period simple moving average, and the black line is the 15 EMA. Oh, thank you, Jimmy. So Bill Williams came up with the squat bars. Thank you very much. I like to give credit where credit is due. Yep, very good. I learned it from someone else, but I wasn't sure if he was the inventor or not. So evidently he was not, since I learned it from another guy. Okay, so let's move on. Oh, unfortunately, Frank, I don't have time to go into momentum on the longer term time frame. I don't have an example. We got just slides here, as you can see. That would take longer. That would be like a whole presentation unto itself. And I've got just enough time to finish up with this one. Good question. Unfortunately, I only have so much time, and I'm trying to stay focused only on volume stuff today. But as I said, I don't trade any of the things I'm showing you here today. I do not trade them just based on this evidence. So this is volume is one piece of evidence you could add to a complete trading methodology. And a complete trading methodology would include things like looking at your individual candlestick bars to be able to read them accurately, multiple bar patterns, trends, cycles, momentum, support resistance, and then you've also got to look at your trading psychology, money management, risk management. All that stuff incorporates a trading methodology, but we can't cover it all today in 45 minutes. So we focus on one thing at a time, and I try to, just basically open your eyes to some, hopefully, new concepts that you can incorporate to your trading methodology. Okay, here's one thing, support resistance levels. So many different types, right? Fibonacci, floor trader pivots, various types of pivots. In fact, you get your traditional floor trader pivots, you get some others. Here's one that I consider one of the most important. And people ask me a lot of times about what things are most important about various things, and that includes support resistance. So for me, at least, I consider these to be the most important support resistant levels, more than Fibonacci, more than floor trader pivots, more than the others. They're all good. They're all good. But if I was going to rank them, I would rank this as the number one. So we look for volume spikes. Again, coming back to our volume spikes, shows a lot of market activity. And we've come down. Now, this is important. Markets come down pretty dramatically at a very steep angle, and it bounces. So you look at the price where it bounced, then that's about what, 41.80, let's say. Can't tell exactly, but around 41.80. So what that means is, remember, supply demand, back to the origins of our principle here. So supply demand, that means that it's kind of like car lot. Let's say that, in fact, I can actually tell you a real brief story about that. So there was this really cool car that came out, and it was the first year this cool car came out, and Chrysler, who came out with it, they weren't sure if it was going to really take off or not. It was a concept car, and I guess it became popular enough, through the auto shows and so forth, that they decided to make a production model out of it. But they came out with a very small run because they still wanted to test it in the real market, right? The people who are going to buy the car. People say it's cool, but will they really buy it? That's a whole different thing. So they came out with a very small run, limited what? Supply. And now they're seeing how much demand there is. While I was waiting, and I got myself put on a waiting list for that car at my local dealership, Chrysler. And so sure enough, car finally is released. There was a delay on it. And finally, they give me a call. Oh, got a few of them in. Come on down and get one. So I go down and get one. Guess what? They were gone. I'm like, wait, you just called me like 30 minutes ago. It's like, yeah, they're all gone. We only had 3 of them and they're all gone. Like, dang. So I said, well, keep me on the list. Oh yeah, when are you going to get some more in? I don't know, but we'll get them in because they sell like crazy. So, okay, a little time went by, called me again. So this time I just ran down there. I didn't even go to the bathroom, nothing. I change clothes, just went down there, gone. I'm like, no way. Yeah, all sold. I'm like, well, what about that one? They're like, well, they're rating that up right now. I'm like, oh man. Third time I got called, got down there. They had one left. I'm thinking I'd be able to choose colors, and nope, that's it. Two were sold, one was left. And so now it's a car dealership, right? So I'm thinking I'm going to negotiate. What do you think? Was I able to negotiate? Yes or no? Type in your answer, and let's see who are the stars of the show, who understands supply demand. Because you go to a car dealership and that's normal, right? You should be able to negotiate well, I'm not going to pay MSRP. Yeah, you guys are all right. You're correct. No, I couldn't. In fact, not only could I not negotiate the price of the car down, they said, oh no. So I said, well, so I'm going to have to pay the sticker price? He says, no, you don't have to pay the sticker price. I said, oh, well, I hope not. He says, no, you're going to have to pay $10,000 above sticker price. What? Are you serious? $10,000 above sticker price. He says, yep. And I said, well, I'm not going to do that. He says, okay, bye. And at first I thought, oh, he's just playing his little sales deal. Oh no, he wasn't. Because I just stood there. I didn't walk out, but more people are walking in, and I'm like, okay, I'll take it, and I did. I, I. Oh really, Tony? That's how you did it? So yeah, I paid it. Why? Because I wanted it. Was it worth it? I don't know. How do you determine that? How's price determined? Well, something is worth essentially what someone will pay for it is what they say. At least in sales, I guess that's what they say. Other times things do get overpriced and they're not really worth it. Warren Buffett, he's not going to overpay. He wouldn't have bought that car. Right? He's a value investor. And sometimes things do get overvalued. And you know what? I never got my money back out of that car. Of course, you don't normally get your money back out of cars anyway. But it was just pure emotion. Why did I want it? Because it was cool. That's it. Well, anyway, the same stuff happens in the stock market. And we've seen it happen in the stock market. We've seen it happen in the real estate market. The tech bubble. What about all those tech companies? Were they worth those valuations? No way. They weren't. Did most of them go out of business? Yep, they sure did. But why did people run up the price? Because they were excited. Tech was exciting. And so, as Alan Greenspan said, the market had emotional, or what do they call it? Oh, irrational exuberance. And so anyway, that's what establishes prices. And so people say, oh, well, I don't rely on technical analysis. I just do fundamental analysis. Well, that's fine, except the markets mostly trade on, it's both emotion and logic. But what will establish price, at least for short-term trading, I'm not really talking about long-term investing here. I'm talking about short-term trading, is what are people excited about it? Are they going to trade it? There's a lot of really good financially solid companies that are really cheap on the stock market and probably should go for more. It doesn't matter why, because people don't care. They're not interested. They're not excited. But they're great, great, great financial companies, very financially sound. They're great businesses. But when it comes to trading the markets, it's all about what the other guy's willing to pay or the other people. So, and the masses. So that's where volume comes in. So anyway, long story turned long. But anyway, let's get back on track here. So when you get these big volume spikes, that's when people decide, oh, okay, it's kind of the opposite example of what I gave you. They'll come out with a car that's a clunker and nobody likes it. And so what does the car dealership do? If a model comes out, nobody buys it, they lower the price. Nobody buys it. They lower the price the third week. They lower the price, the end of the month or whatever. And they just want to get them off the lot now. They might even sell them for a little bit of a loss because they don't want to pay transportation fees. They got to clear out the lot that's taking up space. They want those parking spaces for cars that are going to move. And so that's actually costing them money just having cars sit there. So it's actually worth it for them just to get it off the lot. And so price comes down, then it comes down, until people are like, well, I'm not really that excited about the car, but god dang, now it's not a deal. Now it's a steal. This is just a great financial opportunity. So it's kind of like that thing when the markets come down and then everyone comes in and buys and says, oh, this is a great deal, I'm buying. And so it goes back up, but that might only last for a little while as it does on this chart. And then it comes back down. So professionals, we're watching these price levels where the buyers came in with enthusiasm, saying that, oh, if this is the price where the market participants consider this a steal, not just a deal, but a steal. And so now things can obviously change as time goes on. About what, 2 months goes by here in this process. So then in March, things could change, news, financial reports, all that kind of stuff, but it's a reference point that we look at for where people would come in with enthusiasm. Again, notice at that point, price bars just barely break below that low. Just that's what I always love to see. Always love to see these little bull and bear traps, and then boom, off it goes to the races. That's my favorite type of trade to take. The last bonus I'll share with you, and then I've got one more thing just for day traders for a little more advanced stuff. Since volume's not an indicator, since volume is just statistics, it's just the numbers, it can be a little confusing to determine, well, what is high volume, what's low volume, and what's average volume. So because all the bars are just kind of relative to each other. So I put a 20-period simple moving average on top of the volume histogram. And I want it to be the simple moving average because the whole point is here to have a very smooth line. So it just gives me a reference point when the volume bars are well below that 20-period simple moving average. That is considered low volume. In the middle of the chart, volume is roughly equal to the 20 MA. It's touching it on most bars. So therefore I say that's average volume, which it literally is. It's average to the last 20 bars. And then when price bars get well above the 20-period moving average, I consider that large volume. So it's a way of taking these, little differences in the height of the volume bars and turning them from subjective to having a more objective reading of them. Okay, now let's, Bill, isn't that emotion and illogic? Yeah, absolutely. Yeah, who said the markets are logical? Yeah, it remains illogical longer than you can remain solvent. Yeah, exactly. That's right. So now let's get down to some day trading stuff. So with day trading, here's a way that I love to use volume. So this is a time and sales window. And I've got the example of TradeStation, as you can see, but there's other platforms you can use for this as well. So I edit my time and sales window. You see there the column that says type. For me, at least, for my purposes, I don't want to see the bids and the asks. I just want to see the actual trades. In other words, where people actually had their money leave their account, because now I know they're serious, they're committed. A bid or an ask, there's no commitment yet. But when the trade is executed, oh, believe me, these guys, well, all of us, when money's left our account, okay, now we've made a commitment, right? Now we're not dating, now we're not engaged, now we're married. So I edit that to only show the actual sales, right? The actual commitment. Then, oops, that I did a different slide on the next one. Then under size, see the column that says size? Now this is the NQs, the futures. You can do this with other things too, those stocks. So with size, the size column, I edit that as well. And in this case, I've edited it so that I don't see anything less than trades of 20 contracts. So what that means is it's not going to plot up there unless one trade, by the way, that's the key thing. Each one of these is one trade. So we're measuring volume in a different way now. Is that it's not that 20 contracts went through the market, it's that one trade of 20 contracts went through the market. So think about what that means. The average person who is a retail trader, an amateur trader, whatever, they're not trading 20 contracts on the NQ. They don't have a big enough account to do that. They have enough margin to do that. They might trade 1, 2, 3, 4 contracts, maybe 4. More likely 1 or 2, not 20. So the reason that I've filtered out anything below 20 contracts is because I want to see, okay, what's the smart money doing? Now again, it's not a lock, it's not 100%, but at least I'm looking at people with large trading accounts, which are more likely to be people who know what they're doing, who are more likely to people who are making money. Okay, again, it's not 100%. There's people with big money trading and they don't know what the heck they're doing. They're still amateur traders. They just have a lot of money. And then the other side of it, even if they are professional traders, well, they have losses too. So it's not a guarantee. It's another piece of evidence. All right, but it's a pretty cool one. So if you were to draw this, and you actually can do this, get a block trade indicator and put it on your charts, you can see here that it would draw the volume bars, but there's not one under every single bar, not under every single price bar, that is. So what you're seeing is these block trades are only plotted under certain bars, and in this case, only bars that had uh, individual trades of 20 contracts or more. Now, it might be one or more. That's why you see some of the volume histogram bars there are longer or taller than the others. That means they had more 20 contract or more trades than the other ones. So that can be very helpful. You'd have to ask your trading platform provider if they have that indicator or not. Now, here's the one that that I like. This is, again, what I've shared with you so far. Again, nothing super unique. This little approach here, again, probably somebody else came up with it before, but I don't know. I don't know of anyone who did. So this is what I do. I use two time and sales windows. In one, I filter it so that it doesn't show me any more than 2 contracts per trade. On the other one, on the one on the right, in this case, I've got it no less than 20 or 10 contracts per trade. Notice the price on both are the same, 1205.75. So I'm watching them both go through. So essentially what I'm doing is I'm doing an X-ray, and I'm distinguishing, okay, what are the amateurs doing? Are they buying or selling? And then in the other window, what are the professionals doing? Are they buying or selling? In this way, I can see, okay, so again, it's another piece of evidence to use in my trading methodology. And by the way, just looking at this, let me ask you, if you were to see this at 1205.75, would you be more inclined, all other things being equal, to want to go short the market or to want to go long the market? Go ahead and type that in. Oh, Sean, what is that screen called? It is the time and sales window. Yeah, pretty intuitive, right? Yeah, don't have to be the sharpest tool in the shed. Exactly, long, pretty obvious. But see how you get this insight that otherwise is not, you can't see it on a chart, in other words. So that's why I call it kind of an X-ray into the amateur and professional traders. So Jeff says, but I normally will go short without knowing this. Well, I don't know, maybe. But yeah, the point is, this is pretty cool to see. Pretty cool to see. We know that most people lose money trading. Most of the ones who lose money trading are probably trading 1 and 2 contracts. You know, somebody's trading, we got 159 contracts buying over there. Dang, that's somebody who's got some serious coin in their account, right? So, yeah. Now, again, do you always get this kind of, first of all, you notice that there is some red over on the right one. And so you've got to account for, well, wait a minute now, maybe someone's selling here because they're taking profits. Doesn't mean they're going short. It could be that they're selling and just taking some profits on a position previously taken. So I want you to understand that it's not just completely binary in that all, but on the other hand, you know, you look at, this is where, again, you put all your evidence together of your chart, and let's say you get a nice setup on your charts, great candlestick patterns and all that. Just, you know, it's a good thing to take a little look over here and see this and like, oh, wow, yeah, the trades that are coming in on the big side, much, much more bullish. And It's just uncanny, by the way. Have you ever noticed how when you were an amateur, if you're still amateurs or whatever, and again, that's nothing derogatory about that. We all started out as amateurs. That's just the way of, normal learning curve. But I'll just speak about myself. I should just put myself on the spot here. So when I was first learning trading for the first couple of years, actually, it seemed uncanny. I was almost always on the wrong side of the market. I mean, it was so ridiculous because it wasn't, I could have understood it if it was just like a coin flip, like 50-50, right? Yeah, 50-50 wins, 50-50 losses, whatever. Then it could be just random or chaos. But it wasn't that way with me. When I first started trading, I like almost always lost. And so it wasn't randomness, it wasn't chaotic. It was like there was a logic, there was an intelligence on the other side of my trades. And I came up with conspiracy theories. I thought, I remember one I came up with was, oh, my broker. Who could see my trades? Because someone's trading against me. They're watching my trades and they're trading against me. Who could see my trades? Well, my broker. So I actually pulled out my paperwork with my broker, and sure enough, right in there it said that they withheld the right to trade or to take the other side of my trades. And of course, that added fuel to the fire for me at the time. And then I thought, oh, it's the market makers. They're running my stops. They're like, oh, Barry took a trade. Let's run that stop. Like they knew or cared who I was, right? So the point here is, if that resonates with you, most people are wrong most of the time, most amateur traders. And so wouldn't you want to trade the opposite of them? If you can see what they're doing, that's almost like an indicator unto itself, is to do the opposite. And if you see the big money, and literally the big money is what we're looking at, and they're doing the opposite of what the small money is doing, dang, pretty good indication of what the right thing is to do. Okay, so what I've taught you here today is very robust, very adaptable. We focused on supply demand, we focused on volume. So this works for stocks, forex, futures, commodities, options. I will give you one caveat here with spot forex, however. With most spot forex data feeds, what they're giving you is tick volume. And what tick volume means is that they are showing you the number of trades, but not the size of those trades. So in that case, this doesn't work as well. One workaround, you could talk to your broker, talk to different Forex data feeds and see if you can get the kind of volume that you need. Or if you insist on trading spot Forex, you can still look at a futures Forex market. They trade very similarly. The patterns, if you look at the charts, are very, very, very similar. And in the futures Forex markets, they do give you real actual volume. Okay, so that's one workaround. Time frames, same thing, pretty much works the same. Day trading, swing trading, investing. Again, a caveat here. For day trading, there is a meta pattern that I call the saucer pattern. And you kind of know this already, I'm sure. Most trading occurs generally in the morning and secondarily in the afternoon. And generally the markets quiet down during lunchtime, midday. So if you were to draw, well, kind of like a moving average or whatever over it, it would form a saucer. So just keep that in mind. The patterns are still valid, but if you see declining volume coming into lunchtime, it's not that the patterns are not valid. It's just, well, this is the normal ebb and flow. So kind of expect that and be weary of taking trades like trend continuation trades or whatever into lunch. Having said that, I will tell you that maybe about once a week or so, roughly, and of course they're mixing it up all the time intentionally, there will be professional trading coming in during lunchtime. And I have heard, and I do believe that that's done intentionally to throw everybody off, because everybody in this parakeet knows that, lunchtime, people turn over their accounts to their interns, whatever, and just say, basically do no harm. But every once in a while, they try to throw the rest of us off, and they will come in with some big trades, and there'll be a nice trade during lunchtime, maybe once a week or so. Anyway, don't worry about it. If you catch it, you don't catch it. I'm just letting you know. here's another really important thing. You don't have to catch every big move in the market. First of all, you won't. You're not going to. And it's not your job to. It's not your job to. Have your trade setups that have been tested over a large sample of data that you know you can trade, that resonate with you, your nervous system, your brain cells, you feel confident with, and just trade those. And the rest of the time, let the market do whatever it's going to do. And don't have trader's remorse when the market makes a big move, but it didn't fit one of your trade setups. Who cares? Market does all kinds of crazy stuff. And sometimes there's no way to actually know that, that move was going to happen before it happened. That's the whole key. The key is, is there any high probability trade set up there at that time? Just because the market made a big move doesn't mean there was a high probability trade set up there at that time. So don't worry about it. Make the market come to you. All right. So here is the freebies that, oops, we got a little bit of a cutoff there, it looks like. Oh, well. You can see it there at the top. So here's the freebies that I have for you today. As I mentioned, I don't have anything to sell to you this evening. So feel free, if you'd like some of my freebie stuff, just go to topdogtrading.com/Bigelow. And what I'm going to do there is I got 3 things all at the same link. It's all at the same link. Just go there. And the first thing you'll get is my rubber band trade. It's a complete trading strategy. It's one of those trade strategies that I talked about where I wait for the market to come to me. It's based on price structure. That's a price structure trade. It's a reversion of the mean mathematical model. And I show you the entries, the exits, all that kind of stuff. So that's a complete trading method. Just one strategy there, but feel free to take it, test it. If you like it, feel free to make money and enjoy. Within that also is my free trading mini course. This one's called How Pros Trade Different Than Amateurs. And, I referred to that a few times throughout our presentation here today. So got my little mini course on that. That's 5 videos. And actually, video 4 of that course is the rubber band trade. And then if you are interested in my cycle indicator, that's something that I share with people. It's actually a modification of an indicator already in your charts, by the way. It's not an indicator you download or anything, so you can use that on any charting platform. We're simply modifying an indicator that's on every charting platform out there. But the key is I show you how to use it to time your entries with amazing precision. So again, that's a topic that deserves an hour unto itself. So I offer those webinars about once every 2 weeks or so. So once you sign up there, I'll send you an invitation to the next one, whenever that's going to be. And we go through it for an hour. We get it set up on your charts, and I show you exactly how to trade it, all for free. So that's it, my friends. Hope you enjoyed it. And Steve typed in the URL there. Thank you very much, Steve. I do have another presentation. I have a coaching program actually after this, but I'll stay around for just a couple minutes. And I've got like 4 minutes literally, and then I got to jump on the coaching call. So if you have any questions, feel free to type them in right now, and I'll be happy to answer them. Let's see here. Oh, wonderful. Lindsay says, always learn a lot from you. Thank you, Dr. Burns. You're very welcome. Good, Sean. Oh, good. Yeah, well, you're very welcome. David, by professional, could the biggies just use program trading during the lunchtime? Sure, they could. Absolutely. Absolutely. 100%. Yeah, over half of the volume in the stock market is traded by, automation now, not by actual humans. So, okay, a lot of people just saying thank you. Donald, do I ever use Chaikin Money Flow? Yeah, Chaikin Money Flow is great. I don't really have time to go into how, but it is a great indicator. And I know Mark, he's an amazing man. He's, in my mind, he's a living legend. So, yep, he's great, and that's a great indicator. Unfortunately, I don't have the time to go into the details. You could go to him for that. Go straight to the source. Let's see, Jeff. So volume will spike at bottom or trend or a reversal point. No, not always. See, that's the problem. That's what everyone thinks. They try to make it too simple. So you have to put together several things. So in this instance, for example, step one was it had to be an extended trend. Now we have ways of objectively measuring what an extended trend is. So extended trend comes first, then a spike bottom, spike volume spike, and then I prefer to then wait for the retest of that low on low volume, and the ideal situation would be for just to take out the stops below the previous low and then go up. Now, does that always happen? Of course not, because the market doesn't always do what I want it to do. But I just wait till it does. And I'm just always watching and scanning and doing my scans and looking for those setups. And when they happen, great. And anything can happen. Sometimes on that, when you get that big volume spike, markets go straight up from there and they never retest that low. That's cool. And the people who trade that setup, then they make money. And good for them. I got to let other people make some money. I can't make it all. I'm just joking. But anyway, yeah, that's it. Let's see. Yes. So the moving averages are they're 15 EMA. That one's correct. But I used the 50 SMA, 50 simple moving average. Yeah, Lindsay, right. Correct. Okay, Jeff, good. Yeah, let's see any other questions here. Okay, good, Sean. I'm glad that helped. Phil says it's very hard to see those time and sales windows. Why is it hard to see them, Phil? Elaborate on that for a minute, if you would, please. Sean says, I think you have to pay for those time sales data. I don't know. I'm not really sure anymore. I've had mine set up for so long that I forget. Yeah, probably. Well, I don't know. Because it's not market depth. Usually what you're paying for, like with level 3, is market depth. This is not market depth. This is the actual buying and selling at the time. So you may not have to. I don't know. Call your data provider about that, which may or may not be the same as your broker and may or may not be the same as your charting provider. Shri says, I see the rubber band trade. How do I get the other two options? We'll email them to you, Shri. Yeah, we'll email them to you. Mm-hmm. David, you have a podcast and a YouTube channel. Yes, I do. Thank you, David. Yeah. For anybody who wants to listen to the podcast, just go to iTunes, Google Play, Stitcher, wherever, and just type in Top Dog Trading in the search. Same with YouTube. Just type in Top Dog Trading in the search, and you'll find us there. Bill, thank you, Bill. Bill says time and sales is free with Thinkorswim. I think it's free everywhere. I'm not sure. Yeah, Book Viewer is different, Lindsay. Book Viewer is different. It's a similar concept, but in Book Viewer you can see the depth of the market. You see all the bids and the asks. And so if you're a real tape reader, professional tape readers, they use level 3, not level 2, by the way. Level 2 is worth what it costs now. I believe it's pretty much free everywhere. But yeah, if you're going to be a professional tape reader, then you're going to use level 3. So this is it's similar, but there you're looking at the bids and the asks as well, above and below where the current price is. With what I was teaching you today, it's just purely looking at filled orders in real time, not looking for where supplier demand may come in the future based on bids and asks above and below the current price. Just a different but similar technique. Yeah. Okay, my friends. Well, Steve, Rick, Becky, everybody here, I got to skedaddle to my next call. Thank you so much for inviting me. It's always a pleasure to be here. And everybody, take advantage of the free offer if you want to. Also, you can email me at barry@topdogtrading.com if you have any further questions. Be happy to answer them. I'm here for you. Never be afraid to reach out to me. I'm very available, and I just love to help other traders. So again, in fact, I think I can even type that in here, my email address, barry@topdogtrading.com. There you go. All right, everyone. Thanks again. Have a wonderful day.
Thank you, Dr. Burns. Excellent information. Again, everybody take advantage of his information. Anything you can do to add to your mental arsenal of putting the probabilities in your favor, take advantage of it. And you'll find that Dr. Barry's information is going to be highly beneficial. So take advantage of it. Thank you, Dr. Burns. Your information is always very good. So with that, everybody have a good evening. Everybody have a good, safe weekend. And we'll see everybody in the chat rooms on Monday. See you then.